So for infrastructure, the way the regulation works for a lot of our companies is that as bond yields rise over time, regulators increase the allowed returns that the companies can earn. And that's a formulaic process. So essentially as the yields increase, the risk-free return that the regulator takes into account increases, and so does the allowed returns. And so as a result, when you look at these companies over the longer term, the value impact on the companies is pretty much neutral. In the short term, there can be a bit of a headwind. And so we sometimes see is, particularly if bond yields rise sharply, you get some sell-off in some of the infrastructure or the utility companies. That's more related to the dividend yields relative to the bond yields for the underlying companies. So what we've seen in the recent past is rising bond yields, but we've actually seen great returns out of the infrastructure companies. And for us, what's important is we've got the ability to move our capital around the world and to reweight the portfolio from countries or regions where bond yields are rising to countries or regions where they're not. And that way we can provide the stable returns to investors over those long time frames.